So one of the things I look at is the sheer dollar volume of fiscal deficits compared to year over year loans, right? So how much more bank loans are outstanding this year compared to a year ago, versus how much bigger is the public sector debt, compared to a year ago, taking into account TGA, fluctuations,
Mhm.
things like that, how much is actually spent in the economy. And so, for example, back in the 70s and the 60s, loan creation was much larger than the fiscal deficit. So the majority of new money came from, fractional reserve banks multiplying it. Whereas in the current era, fiscal deficits are a larger absolute number than the year-over-year absolute number of loan creation.
Renowned economist Lyn Alden takes us on a deep dive into the complex world of fiscal deficits, bank loans, and public sector debt. She expertly examines the historical trends of loan creation and fiscal deficits, shedding light on how the sources of new money have evolved over time. Alden skillfully dissects the inflationary impact of these monetary policies, highlighting the crucial role of targeted stimulus in driving consumer spending and its potential consequences on inflation rates. Drawing on real-world examples, she illustrates how distributing wealth among different income brackets can have varying effects on the economy, prompting us to question the effectiveness of certain economic strategies. But the intrigue doesn't end there. Alden delves into the challenges policymakers face when dealing with mounting debt, as well as the delicate balance between cutting deficits and maintaining essential social programs. With the U.S. budget heavily invested in popular programs, Alden uncovers the potential political roadblocks that may hinder significant deficit reductions. And as we near the end of this captivating conversation, The Economist reveals the looming trap that policymakers find themselves in: a debt-laden economy where austerity may not be a viable solution. Will the market take matters into its own hands, leading to debt restructuring and inflationary consequences? The answers to these pressing questions lie in the final part of Alden's insightful analysis. Prepare to be enlightened as Lyn Alden leaves us on the edge of our seats, guiding us through the complexities of monetary policies and the challenges ahead. Stay tuned for the riveting conclusion, where we uncover the possible fate of a financially driven world.
And so that's number one, is just kind of looking at absolute magnitudes. But then you have to adjust both of them for how inflationary they tend to be, right? So on average, I use this example in the article. I mean, if you gave out $1 trillion to like the top 10 or top 100 richest people in the country, like all the Warren Buffetts of the world, they wouldn't go out and buy more with it. They already can buy anything they want, and so any money you give them is going to go into financial assets. And so you might increase the value of the stock market, but you're not going to probably increase the price of hamburgers, because these 100 people are not going to buy more hamburgers. Whereas if you took the same trillion and you gave 5,000 or 10,000 each to the bottom 100 million or 200 million people, they're going to go out and buy stuff with it, because their spending is constrained by their income, and so they're gonna pay off some debts, or they're also going to spend more. It depends on the individual, but a lot of that will get spent pretty readily into consumer types of things and drive up inflation. And so interest expense is challenging somewhat to measure, but on average, it does tend to go a little bit more towards the upper end of the spectrum, right? So it's not the
Yeah.
same. It's not going to have the same inflationary impact as stimulus checks, childcare tax credits, that sort of thing. It's going to go to fairly wealthy retirees. It's going to go to bond funds. It's going to go to banks. It's going to go to insurance companies. It's going to go to some pension funds. So that's the ones that will have a tendency to spend it are people who might have otherwise lost their pensions that won't, wealthy retirees that have more income coming into their portfolios than they did before. So you do have a greater propensity to spend, but it's lower than what you get in other types of stimulus. You also see about a quarter of it just goes out of the country, because about a quarter of Treasury debt is owned by the foreign sector. And so some of that can go out elsewhere. Now that can still be inflationary because, for example, that could be used to buy commodities and potentially drive up global commodity prices. But it's not this like quick acting thing. And so in 2022, we saw that the pressure on the private sector was bigger than what we were seeing from the public sector. So far in 2023, it's more of a tug of war. You still see disinflation happening. You still see recession indicators mounting, but these things are coming down slower than a lot of people thought. And I think a lot of that is because you're basically running $2 trillion deficits into the economy. It's almost like you're pre-stimulating. It's not the most
Hmm.
targeted form of stimulus, but you're still in a way pre-stimulating before you even have a recession, which kind of drags things out, makes things more stagflationary rather than a big deflationary bust type of thing. Yeah, I think it's very low, especially I mean, it depends. It's like country by country basis.
Yeah.
Um, but especially for like the United States and Japan and countries like this, generally policymakers are not going to look at interest rates and say, well, because interest rates are higher, we're going to spend less. It's just not how they work. And so I think that is probably going to be very difficult to address. Another challenging thing, let's use the United States as an example. The vast majority of the federal budget is military, Social Security, Medicare. Um, and within military, you can also add things like Homeland Security and veterans benefits, things like that. So collectively, these are all very popular programs, right? So the people that tend to vote are older, and they're not, any candidate that says, "Hey, we're going to slash Social Security and Medicare." I mean, you're good luck getting elected and then actually getting a coalition to agree with that. We've even seen in the Republican Party there's somewhat of a split there. Trump, for example, is a he wants to preserve those, whereas there is still a segment of the Republican Party that's more of the fiscal hawk type, kind of the back in the day it was like the Paul Ryan type where they do want to trim some of those. But in general, in modern years, the Trump wing of the Republican Party is dominant. So whether or not you look at the Democrat side or the Republican side, generally cutting these programs is like a third rail. Um, and that's where the most of it is coming from. Another challenge is that once you get to this height of debt to GDP, and once your economy is this financialized, you can fall into a trap where if you actually try to cut the deficit, it can cut the GDP by just as much, and so your deficit as a percentage of GDP is actually still just as big.
Yeah.
So austerity works when you're starting from a position of strength, um, but when you're already this financialized and this indebted, um, there's not that many ways out. It's kind of like if you just took the finances of the government and said, okay, here's this unprofitable corporation with this it's like debt to sales multiple that's like super high, debt to income's off the charts because income's negative, and it's like what is the chance they're not going to default? And it's almost zero. They're going to default. Of course, now if you give them a money printer, they're not going to default. But I think that's the problem that they find themselves in, is that in addition to having to pivot towards austerity, they're already in this trap, and some of the debt just has to be essentially restructured, defaulted on, inflated away. And of course, nobody, that's not a decision that anyone's going to actively make, but it's just going to kind of, I think, be made for them by the market as we kind of grind through this.